Welcome to DASAR. My name is Darshan Doshi, and we have an awesome podcast guest with me. My close friend Rohan Koshy. He's a part of the New Horizon Fund. He's been in the investment world for almost a decade now. And in this podcast, he covers right from the basics of what is the stock market, what is the art of picking stocks, how do you ideate, how do you generate ideas for investing in the stock market, when does it make sense to invest in the stock market? How do you approach investing to the stock market? Should you invest in direct stocks? If so, how do you evaluate? He even goes into the depths of how do you research for stocks? How do you value these stocks? What are the popular methods? And then how does psychology or how does long-term thinking affect your stock market returns? So we've covered a whole lot of things. Rohan has been amazing in this podcast. I hope you enjoy this. And if you learn from it, be sure to drop us a note or hit reply or share it with your friends. The more people who become educated with personal finance and investing, the better it is as a society. So go ahead, enjoy this podcast.
So, I had a crystal ball which told me today the market is going to crash significantly. And so I brought in all my eight senses to invite Rohan for this session. Of course, I'm just kidding. Rohan, thanks a lot for joining and taking this session. Today, we saw a 3% market correction, roughly, in the Indian stock market, if you've been following. And there are two lines of thought. If the market is dropping by 3% means people are selling, but that also means if you're someone who has been a good investor, you could potentially look at this as an opportunity to build your portfolio and invest in the long term.
So I'm just going to get started. See, the one thing that people do when they start their investing journey is essentially there's this guy, right? And the idea is that a lot of people think that you can do this on your own. And it is true to a certain extent, right? But there are certain things that people tend to forget about how difficult it is. And they should keep that in mind as they start their investing journey, right? So let me I know this sounds very basic, but a lot of people forget this part. And for those of you who are either building a business or have built a business, the stock market is about access to capital, right? That's the main function. And that's the primary market, that's the IPO market. And what we do, trading and making money, is not a function of the market. It's not what the market is designed for. That's just an outcome. But what it does help is price discovery. Price discovery is essentially every business is valued at a particular level, and that value gets determined over a period of time. And that price discovery informs how capital markets function, right? I'll touch upon an example later where this kind of comes, you kind of figure out why this is the case, right? So why does it generate wealth? It's not there to generate wealth, but it does generate wealth. It's primarily because you're betting on people. So all the people who are here at 8 o'clock in the morning or 8 o'clock in the night are essentially very interested. They are doing their own things, but they are essentially working hard and being innovative. And the market allows you to benefit from that, provided you put in some effort of your own, right? And so it's not gambling. It is definitely very far away from that. There is one element to why you're investing in the market, because you have an objective, right? There's no other reason for it. The objectives are essentially very simple. You want to get to a level of wealth which makes you comfortable, allows you to do something, which depends on everybody, right? And that part is really for you to figure out what it is. But essentially it falls into 4-5 things. I want to make enough money to take care of my family, either quit my job, do a startup, fund a lifestyle, retire early, any of those things, right? There are a few things you must realize. There is no points for effort in the market. You can earn enough returns without putting any effort, which is essentially what's called a passive fund, right? It's called passive investing, which is where you don't do the research. You just take a call as to how to allocate your money, right? Because when you're doing your own research, when you're doing your own stock market investing, please understand that for every time you buy or sell, there is somebody on the other side. And usually it's somebody very motivated, working very hard. So it's not as, because it generates wealth over a period of time, but the markets can be pretty brutal for people who don't do the work, right? Now, I'm not trying to discourage you, but this is how I kind of started with my journey. Is that first I said, okay, if I'm learning, let me give myself 3 years. Let me, if I have an X amount of money, let me allocate a large part of that to managers. Give myself some part, say 5 or 10% of it. Let me see if I can keep up or beat the market. And then as I get more comfortable, let me allocate higher and higher, right? And that's the easiest way to kind of get into it. So that, remember, you're just trying to generate wealth, right? So there are two ways. One is passive, which is essentially you allocating money to these mutual funds, and you can see the returns that they generate. This is without doing any work. Or you can say, okay, I am putting money with them, but I am also going to do my work because this interests me. Right? So while I've given you the reasons for why you shouldn't invest in stocks, which is what I recommend for a lot of people, there is a reason to kind of do this itself, right? The, and there are 3, 4 reasons. One is essentially because everyone here is very young. You have a long time to learn this skill. You don't need anybody else. It's one of the few endeavors in life where you get better as you age, which is a great thing, right? Because everyone here is young. You can be investing till you're 90. And you can generate a lot of wealth simply by sticking around for a long period of time, right? And what I found is that as long as people are there for a long period of time and don't do something crazy and lose a lot of money, they generally tend to figure it out. So there are no secrets. This is not like, uh, you know, if I want to become a pilot, I can't quit my job and say, hey, give me 10 years, I'll learn it on the side, right? There's just no way to do that. But with this profession, you can theoretically do it, and many people do it. So that's really why. So you've got to sort of start off by asking yourself this question: is how much effort do I want to put in, right? And that's a main question because you have a day job or you are doing something with your time, right? And that kind of gives you, if you say, okay, I'm going to put in 20 hours a week, then at least you know. And then you start from there, and then you can kind of decide first how much you want to allocate to mutual funds or external managers, and then how much do you want to do yourself for your own money, right? There are certain things you have as an advantage which a fund manager does not have. One is you have a very long-term view. You can take a 5-year view, which most managers cannot take. That much I can tell you, being in the market. Nobody, if I tell somebody that I'm putting 50% of my fund into a stock, which 5 years later will beat the market, I will have no clients because clients cannot wait for 5 years, right? But you can do that. Uh, the second is you all work in a sector, right? If you are a pilot or if you are somebody who has a startup in VR, there are certain industry expertise which can uniquely help you determine whether you want to invest in a business. The, the kind of issues I have seen is that the people, let's say, who work in IT want to invest in oil and gas. And then there are people who work in oil and gas who want to invest in aviation, right? So they never think that the sector that they are in is where you have an edge, right? That's so. This is basically defined as where is your circle of competence. right? So let me give you an example. FMCG, which is essentially all your consumer goods, is an easier sector to understand. Something like pharma is not. It's not that easy. So when you start out your investing journey, you've got to figure out, where do I want to invest, right? Where are the fish? And that really depends on you and kind of your background and where you work, right? And the third thing is, you can diversify or concentrate as much as you want. Like if you today decide, hey, I don't like the market, you can say, okay, I'm shutting shop. I'll see after 2 3 years, and nobody will come and tell you. These are calls that managers cannot take. Only people outside the market, or who don't have a boss, they can take these calls, and these are significant advantages if you are someone who's doing this by yourself. And the reason I'm kind of today is kind of like an opportune day, because these are all the events that have occurred over the last 30 years, right? And the fact is, all of these events are events that make you worry, right? But the march is pretty much up and to the right over a long period of time. But then, like I said, you got to sort of stick around and say that I'm going to be doing this for a long. And so when I look at these things where I go up and down, I kind of view it with a larger lens, right? So at any point in time, you could have exited the market here when all these worries are there. Just like if you look at today's market, where you have all these global issues, you can say, okay, I'm taking a call, I'm going to leave the market, it's too high, there's a crash coming. And actually, when you are in this part of the market where things are going south, it feels a lot worse than it is, right? Because let's say in 2008, the market went down 60%. The market is down about 14% for the year so far, but it feels like a lot more, right? So what you have to figure out is, as you do this over a period of time, you are still doing it on the right side of generating wealth, right? Because the market essentially has all the most innovative companies in the country, or whichever country you're investing in, right? And you are essentially betting on those companies. And because they innovate and they create value, you get to kind of ride piggyback when you buy stocks in those companies. So that's the way you've got to sort of think about how you invest and for how long you invest, right? And okay, so just coming, if you have any questions at this point, after this, I'll kind of start how to kind of go through the process of researching a stock. But if you have any questions so far, please let me know.
I think we'll continue, Rohan, and then if anyone has any questions, just unmute yourself or put it in chat, and I'll bring it.
Sure. Okay, so essentially the investment process is simple. It's not easy, but it is simple. There are only three parts to it. One is idea generation, one is stock selection, and one is portfolio management. And really, all three parts are equally important. A lot of people just look at stock selection and think that's kind of the end of the investment process, but it's actually in the middle. Idea generation is probably very, very important, right? Because what happens is, you're looking for a core insight into a stock, right? Why do you like the stock? And so you've got to look at where your ideas come from. And ideas can come from anywhere, but you've got to sort of have this thing that every time I hear about a company or I hear about a new service, I kind of research it. I have a look at it. I think about it deeply. And that's really how you come across ideas, right? Because what happens is, a lot of people get interested when somebody mentions a name to them, which is not always the best way. Because what happens is, the other person has done some research and they have a certain amount of conviction on it, whereas you do not have that conviction because you did not come to that conclusion by yourself. So let me give you an example of one way that we do it, which is called screeners, right? So screeners essentially is, you run a bunch of what's called a screen for certain properties of stocks. And then based on that, you come to a list, and then you look into that list, and then look for ideas, right? So let's say, I don't know if you can see my screen. Sorry, Darshan, can you
Yeah,
see
we
this?
can. Yeah, we can see it.
Yeah, just one second. Okay, so this is a website that you can use called Screener. I've done a simple screen today, which is essentially 20% lower than the all-time high, right? If you can see this, this is how much lower it is than the highest price it had over the last 52 weeks, right? And all these stocks are down 50 to 60%. Now, this is a way to sort of generate an idea, right? You're looking at all these stocks and you're saying, okay, all these stocks are down so much. Do I have expertise in a stock where I can take a call and say, hey, this is overdone, right? Because remember that most of these businesses don't fluctuate 50, 60% year on year. The business performance does not. Just to give you an idea of how to think about that is, I'll just take an example of, right? This is an example of HDFC Bank, which is a stock we all know. This is the high and the low in every year, right? This is the difference between the high and the low, right? So if you can see at any point in time.
Can you zoom in, Rohan, a little bit?
Sorry. Can you see this?
Yeah, better.
Yeah. So this is the stock price of HDFC Bank over the last 25 years. And this is the difference between the high and the low price for the year, right? So when a stock is down 50%, it does not mean that the business is bad. The business is good. So the question you really have to see is, let's say you go back to your screen and you say, out of all these guys, are there stocks I can look at which I think over the long term will generate wealth, and I'm getting them at a decent price? So what I mean by the idea generation phase is you've got to look at where you generate your ideas from, and that's so I'll tell you, there are, the majority of times is you experience a product, the product itself makes you feel good, or you think that the service was very good, or it is something you read in the newspaper and you say, you know what, this I think is interesting, right? And then you kind of research the stock, then you look at it, and then you think about buying the stock. So the main part is idea generation is important, because you've got to kind of think of it like you're at any point in time you might have 15, 20, 30, 40 stocks. Now, how do you generate ideas that come into your portfolio, and how do you exit something that's in your portfolio? For that, you kind of need an idea generation engine, right? Which can be anything, but you've got to kind of have this thing that every time I think about a business, I think about how would I evaluate that as a stock. So for instance, when Uber first came into India, it would make a lot of sense to kind of figure out what the business model is. Is it a real disruption that is there? And then think about, okay, what are the effects that has on other businesses, right? And that's how you kind of generate ideas. So today, let's say, if you're saying if Russia has done something, what are the opportunities that could crop up, right? For instance, we know that there's a lot of supply chain in Russia, supply chain linkages. And if those get severed, are there any companies that could benefit from that? So those are one of the few kind of ways, but essentially you've got to think, when you think about investing, you've got to think about your idea generation engine, because this is just as important as evaluating the stock. Most of the time, it's the idea generation which provides the return. Because the stock research is essentially trying to confirm your idea that start with, right? So that's idea generation. This is probably the most important part of today's presentation. If you take away nothing from the rest of the presentation, it's really this slide. The way to evaluate the business is essentially on if you're doing this as a long-term investor in that stock, right? Is really these are the parameters that you're looking for. One is what is the quality of the business? The quality of the business is essentially defined by just by two kind of metrics, which is its ability to generate free cash, and the second is the return on capital that the business generates. Now, there's a whole host of factors that go into that, but essentially, every business and all of you are either working at one or running one, you'll clearly understand that it's a competitive landscape, it's the pricing power, and the ability to generate free cash, right? Let me give you an example out of the US. For the longest time, Netflix was not very well rated because people thought it kept losing cash. The opposite view was that when Netflix required to do it, that it could raise prices. And over the last 3-4 years, it's essentially doubled the price of its service, right? With continuing growth in subscribers, right? So you've got to look at the quality of the business. That's one important part. The second part is really leadership. Leadership of the people is basically management. This part is not very easy to figure out, but there is a lot of return to be generated from understanding leadership, right? Leadership essentially, let's say you look at a stock, right? Then you look at who are the people running the place, and then you try and figure out are they doing the business keeping in mind the shareholders, or are they doing the business for themselves? And secondly, are they really good at doing it, right? So there are very few businesses, probably one or two in every sector, where the leadership is generally viewed as being the best in the business. Now, you have to figure that out because the last part, which is the valuation, incorporates a lot of premium to what the market believes is the sector leading leadership, right? So let me give you an example of a company that we kind of look at, a business that's called Bajaj Finance. I think everyone here probably has heard of it. We know the chief executive of the business, and he literally works 80 hours a week for the last 20 years. And they have a ruthless amount of focus on efficiency, right? Now, why does this matter in a business like lending? Is important because in lending, the rate at which you lend is almost fixed by the market, right? So all home loans are available at, let's say, 7% interest rate. The real profit is really in how good your expense management is and how good your operations is, right? And that kind of determines how much profit you make versus the entire sector. So in every business that you kind of look at, you've got to look at the leadership, because that really is a large part of what creates or destroys value, right? If you own a business, there are many businesses in the sector. Let's say if you look at FMCG, if you have Hindustan Unilever, which is genuinely want to have the best management, they generally have been able to overcome all sorts of adversities coming out on top, whereas others have fallen by the wayside. Which is why Unilever continues to be the most valued FMCG company in India, other than maybe Nestle, which itself has its great leadership. So really, the quality of the business, the leadership, the external opportunity. This is an easy one. And you've got to kind of think about how far the runway is, right? So let me give you an example of where it is not. If you look at a company like Colgate, it would be easy to say that everybody has to brush twice a day, right? It's the most basic function that you can have. And if you take any parameter, if you take any parameter that Colgate throws at you, you will sort of figure out that 50% of India don't brush their teeth, because that's just how many tubes of uh, toothpaste that Colgate sells. Now, the reason for that is there are alternatives which are much cheaper, right? And so what you got to figure out is how long is the runway, right? And for a company like Colgate, it grows 3 to 5% a year, 7% a year. But if you think that it will grow 20% a year, then you have to have some insight into why it will grow at that rate. And that's where the external opportunity matters, right? So if today, let's say if you are starting an airline for any reason, you can see that India is only starting to fly, right? We're still not at that part where pretty much everybody takes a flight. It's still a long way to go. You really have only 2 or 3 competitors, out of which one is good. The rest are really not as good. And so if you find, let's say, a leadership that's starting an airline in India, you know that you have 2 to 3 decades of runway in front of you. And that matters a lot because, as you'll see later on, the value of the business is determined by how much cash it generates and how long it can generate cash for, right? This is very important because what the market does is it essentially breaks up businesses and values them in a certain way, which is what it has generated till now, what it will generate in the short term, and what the market believes it will generate over the long term. And that's really the external opportunity. The fourth one is essentially execution capability, which is um, is what you will notice over a period of time, right? What happens with a business? Can they execute in a way that sort of fulfills the growth potential of that business? Right. So let me give you an example of that as well. So we've all obviously eaten at McDonald's and we've all ordered Domino's, right? There's a very big difference in the execution capability of McDonald's and Domino's. Domino's has gone from 0 to 1,500 stores over 25 years. McDonald's, which runs larger stores, has gone from 0 to 300. And that's essentially the leadership that has run that business. Now, why is that important? Is because Jubilant Foodworks, which runs Domino's in India, is valued at twice the value of the company that runs McDonald's in India, right? So the execution capability is what the market values. What happens is when you look at the stock, you got to kind of go through these parameters and say, where do I rank the stock, right? Is it an A-class business run by an A-class management, with an A-class external opportunity, or is it a mix of these things, right? It's not that every stock falls as A, and A. You can have a business that's in a A-class external opportunity run by a, let's say, B+ management, right? So let me give you an example of that. Let's say you have a business which is essentially into electric vehicles, right? It's clear that the external opportunity is extremely large, but it depends on who the business is. So there's a stock called Tata Elxsi, which is which is kind of it's kind of looked at as the leader in the business because a large part of their business is essentially providing services to companies making electric vehicles. And there's another business called KPIT, which is also there. The market today values KPIT at about 25 to 30% lower than Tata Elxsi because it believes that the leadership and the execution capability of Tata Elxsi is much better, right? And these are the things, when you sort of break down the business, you will be able to kind of fit the businesses in these parameters. So if I look at KPIT, I can say external opportunities A plus, leadership is B plus, right? And then so I will adjust how I value that business and what price I should pay either to buy or to sell that business. So essentially, if you take nothing away from this session, this is really what you should break down how you evaluate a business, right? So this is on the overall basis. Once you understand what the economics of the business is, you can then take a call on buying or selling stock based on how the market values today, right? So that's the second part of really understanding the business. But what I would suggest is, before you kind of get to the part of the valuation, uh, one of the main things is you've got to figure out the unit economics of the business. For most businesses, unit economics is essentially the economics of a single unit, right? So the one I've put up here is for Zomato, which recently listed and obviously generates a lot of interest, right? So this is essentially a breakdown of how the business operates per order, right? So if you look at, let's say in 2020, the estimate is every order is about 400 rupees in value. It generates 12 bucks of contribution margin per order into the number of orders, which gives you the contribution value for the year, right? Now, you're essentially trying to figure out how does it get all of this, right, from a single order or a single unit, right? So let me give you another example. This is for PVR, which is obviously the multiplex chain, right? So what you're trying to do is figure out, if you have one site which has 4 screens, how many seats does it have? How many shows per day? At what price? Essentially, and then what kind of costs do they have in the business per screen, right? So if you can once you do a little bit of reading on it, and most of this information is available, right? You kind of have to figure this out, or if you have access to broker reports, you can just read this part. See, the point of all of that is to sort of come to an idea that this is what the business does, and now I have an idea of what the business should generate, right? So in case of PVR, for a ideal screen, you make about, in terms of just profit after tax, this is what you make, right? This is in million. So you make about 1 crore a year in the 5th year. And then obviously screens don't last just 5 years, they last for 15, right? So you figure out how much it probably will make over 10 years. Now, what happens is, let's say you say that a screen generates 15 crores of profit over its lifetime of 15 years, right? Probably more, let's say 30, right? Then, sorry, you can go to the BSC, you put in PVR, you look at the market cap, right? This is what the business is essentially valued at by the market today, which is 9,000 crores. Now, PVR has about 850 screens as of today, right? So the market is essentially telling you that it values 850 screens at 9,000 crore. So you get a per screen value, right? So what I mean by this is, what this allows you to do is to take a call on whether you think that's way too much or way too low. You're trying to get to the truth of the business, right? So in many businesses, when you do unit economics, it allows you to get a handle of the business. In businesses which have manufacturing, essentially, sometimes you can figure out on a per product or a product basket basis how much money it makes out of one factory, and then it has 10 factories which have this much output, and what it might do over many years is essentially the call that you're taking, right? Why is this important? Is because the single most important metric in the stock market in terms of the correlation to stock performance is essentially a metric called return on capital employed, which is if the business has 100 rupees of capital put into it, how much money does it generate out of the business, right? So that's the simple. I mean, there is a calculation and all that you can. I mean, it's not that difficult to figure out. But essentially, this is how businesses are ranked, right? So let me give you.
Rohan, I just want to bring to your notice we are at 8:55 and we do want to keep some time for questions as well.
Sure. Okay. So let me just go ahead with it. What you're trying to do is essentially all businesses, all financial assets are governed by this one law called discounted cash flow, which is what you do is you take the cash flow it generates in a year, you see how much cash flow it generates over a period of time, and when you discount it back by an interest rate, what is the present value of that cash flow, right? So for a business like Nika, if you look at the free cash flow for 2023, it's essentially 50 crore, just 472 billion, which is expected to grow to 20,000 crore by 2040, right? When you discount that number back to today's value at a interest rate, you get a stock price of 2147. Now, why is this important? Is because every stock price essentially is telling you that this is the amount of cash over the lifetime of the business discounted today that the stock is trading at. So when Nika trades at 2,000 rupees a share, the market is essentially telling you that 50 crore of free cash flow today will go to 20,000 crore of free cash flow in 20 years. Now, you can obviously build all of this, but the easier way is essentially to reverse this process, right? So let's say for Zomato, you can look at the discounted cash flow. All you have to do is essentially say, I think this is too less, or I think this is too much. And based on that, you can take a call of whether the stock is cheap or expensive, right? So in Zomato's case, you're looking at growth of 50% next year, 35% after that, and it basically tails off. Now, if you think that Zomato can grow much faster than this, or it can go much faster for much longer, then the stock price essentially of 90 rupees that this calculation comes to is cheap, right? So what happens is when the stock falls, it's essentially these expectations that get adjusted. So if what happens is if Zomato delivers instead of 44% in FY23, if it delivers 35%, then every calculation after that gets it adjusted lower, and then the stock price falls. Right. So what has happened? I mean, obviously everyone has seen the market. When interest rates rise, the value of that stream of cash flows goes down. So if you can see this WACC, which is essentially cost of capital, is put as 12.2%. If interest rates go up a lot, this value essentially falls, right? So your call when you look at a stock is, are these assumptions too conservative or are they too much? And that's essentially the conclusion you have to come to when you research the stock, when you do all your work. You have to come to the conclusion that is the market expecting too much or too little of this company? Once you kind of have that view, you can essentially take a call on whether to buy or sell, right? And just last part is essentially when you do this, obviously you have to look at all the other companies in the sector, right? These are the QSR companies. Now, if you will notice, they are all valued a certain way, and some of this data is noisy because QSR was shut through COVID and all. But this is how it is valued. Now, when you look at, let's say, buying Jubilant, buying Burger King, you look at the other guys in the sector, and you see how they are traded, and then you come to a conclusion as to why they are traded, right? Essentially the last part of my presentation is this part. If you're buying and selling, you've got to ask yourself, what is the thing that I know that the market doesn't, right? Or what is the thing that I understand that I don't think the market is understanding, right? And that part is really where you make money. Right? If you think that yes, IT services will grow, but everybody knows that. If you think IT services will grow very fast, and if you have a reason to back that belief up, then you are differing from the market, right? And that part is, it's not easy to come to this conclusion, but that's the whole point of the research, is what is your edge on this stock, right? When you look at any stock that you're buying, you've got to think about what is the market, what is essentially the market's expectation of the stock, what is the insight that I have on the stock, right? And that is where you make money, because otherwise, if you on every stock you can't have a view, have to kind of have a you kind of have to have a core thesis on that stock, and where you differ from the market in terms of evaluating that stock, right? So this is essentially how you go about it. I'll kind of skip this. This is certain things you can do to make your investing process better. If you have some questions, I'll talk about that. um, uh, One thing on just psychology, especially in days like this where the market falls up and down, so you got to remember that the market is not the reality. It's just a view of a stock at a particular time that the market has. And you can differ in that view and be correct or wrong, right? So the HDFC Bank, if you had all these stocks that have fallen 50% over the last 3 months. The businesses themselves have not fallen 50% in terms of just revenues or earnings, right? It's just the market's view of that business. So you've got to understand that if you're kind of looking at a stock, you've got to look at your analysis, understand the sentiment, and then look at an entry price. And the same for when you sell the stock, right? So that's buying or selling the stock. And skip this part. The last part, just in 2 minutes, is you got to think about how your portfolio finally is constructed, depending on how much time you have, depending on how much risk taking ability you have. It can either be concentrated or very diversified. There are two types of stocks. Essentially, you can bracket into one's are compounding machines. Essentially, they generate more and more and more profit every year over a long period of time. You try to buy them when they have some issue or some problem, and you kind of keep them in your portfolio. The other part are businesses where something has happened and you can get into the business knowing that the business may not generate a lot of profit over a period of time, but over the next couple of years, it might generate a lot of profit. So, for example, when oil became negative, if you bought a company called ONGC, you were taking a call that oil will come back to a certain level. But today, oil is on the other side. You can take a call saying that this is probably the highest profit it might make. So the process I kind of described all this time is essentially for compounding machines. The way we do it, try to have 2/3 of our portfolio in compounding machines, because that gives you kind of a base amount of growth in profit that is there over a long period of time. And then we try to have 1/3 of the portfolio in deep value stocks, which is essentially you could have oil and gas, metals, any kind of stock where you may not want to hold the stock for a very long time, but you believe that the price is so cheap that it's worth getting into the stock. And then maybe a year later or 2 years later, I'll sell it out because certain things will occur, right? So that's essentially portfolio management. So that's the process.
Thanks a lot for joining us.
Thanks,
Hopefully,
everybody.
this helps everyone to take one step towards, doing the hard work, that is doing the research themselves. And that's what this whole program is all about. So thanks. If there's anything else that we could do for you, let us know. That's not just for Rohan, but everyone, all the participants as well. You have a good rest of the week and see you soon.